Carmelo Oliveri. How we doing today, my friends?
Good, man. Woke up today. It's a good day. That's what I say. How about you?
Oh, doing very well. Doing very well. We're about to close on a $4 million asset in Bayonne, New Jersey.
Nice.
Great location there. They're building a ferry from Bayonne to Manhattan. So I think not a bad place to plant your flag for
Yep.
good investment there. Nice apartment building. So I'm very excited about that. And yeah, lots of things going on over here. I want to have you on, do a webinar here. We're going to talk about the great transfer of wealth. Carmelo and I are going to talk about our years and years of real estate investing experience, hundreds of transactions between the two of us, millions of dollars of wealth created in real estate, and probably a few dollars lost along the way. So we'll maybe talk about all those learning experiences and how we kind of plan to transfer that wealth, down to our heirs over time. Carmelo and I are both family men with children, and so a big part of what we do. I don't want to put words in your mouth, Carmelo, but I know your passion is for your family, to hand something down, create different opportunities for your family that maybe we didn't have. And so that's what we're going to talk about today and kind of how that process is done. But how are we doing today, Carmelo?
Good, man. Good. Hanging in there, keeping busy, grinding, working on some deals. We just purchased 88 unit out in St. Louis MSA. So we're working on that deal. Just a 12 unit here in Hackensack, Bergen County. So working on that deal. So that's just over 100 doors we added to the portfolio in itself. And we did some Airbnbs. We got just over 30 doors in Airbnb the past 18 months. And those are just phenomenal right now. So it's been busy, man, really busy, which is great. So
awesome.
Moving.
Yeah. The Airbnb, I'm kind of mixed on it. I bought some in rural Vermont, and one of my biggest challenges there was finding a good labor force to turn over the properties. And you're running a hotel. It's basically a hotel.
Exactly.
So I had about 6 units going over about 5 different properties in a ski town. So that was interesting.
Nice.
Very, very seasonal, very hard to hire in a, limited population rural town. So I think if I ever do it again, I'll do it like at the shore, something like that, where there is a population. Where are your Airbnbs?
We have Wildwood, New Jersey, and we had one in property here in Newark, New Jersey. And that was a single family house that we had the tenants move out. And I was like, let's try this Airbnb model here, because we got a lot of people coming in Newark Airport, Penn Station, a lot of travelers, and actually working out really well. My wife's like, I don't think it's going to work. But yeah, it's working out really well. So we're renting out the rooms in that property right now. So it's pretty cool. Different concept. And I was like, wow, it works out well.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. What I find with real estate, one of my biggest passions, right, is the whole idea of handing it down to your heirs. Knowing that it's going to hold its value through time, and that people are always going to need a roof over their head. There's tons of tax benefits to it as well. We'll break into, but for the most part, it's just such a tried and true asset class. My story that maybe some of our followers and listeners have heard before, but I invested in cryptocurrency. I came out of a nice real estate transaction, a really good real estate investment. I was very liquid. And as real estate investors do, when we're very liquid, we throw it around. We invest in this. We know what we're doing. We just made a bunch of money in real estate. We're smart investors. And I thought, I'm such a good real estate investor, I must be a good cryptocurrency investor. And I was wrong. I'm actually not that good at cryptocurrency investments. I don't know much about it. I don't really understand it. I got excited because my friends were making a bunch of money and rubbing it in my face. So I decided to jump in head first. So, I learned, real estate, tried and true, makes sense. People need a roof over their head. Banks love it as well. Huge tax benefits. That's why I love real estate. That's why I bought 20 million of it, $20 million worth. And that's what I want to keep doing.
Exactly.
And just investing in crypto and like losing, 2/3 of my money in 6 months. I'm like, wait a minute.
That's crazy.
That's right. That's not a good asset. Maybe in time, whatever, maybe it'll come back, but it's not what real estate is.
No, exactly. Yeah, with the crypto, I looked into it. I remember Bitcoin was $80, and I'm like, what is this? I have no clue. And I was like, it's a made up dollar or whatever the case may be. I was like, if it's not backed by the government, I'm like, a little skittish on it. But I jumped in anyway myself. And I bought 3 coins at $7,500. I sold them for 12.5. But I was like, man, I should have held down to 100,000.
Yeah, that's it. And
I real
never,
estate,
I
so I'll
was,
tell you that much. It's
yeah.
nerve wracking watching those charts up and down all day,
Oh my gosh, and also like in real estate too, I always regret selling. What I've learned through the years is like, don't sell. Don't sell your properties. Seth and I did about 100+ wholesale deals. You were there at the auctions. You see us running around 2016, 17, 18. So we're just moving these things 1-2 a week. Making 20 grand here, 30 grand. It was a great time, right? A lot of cash coming into the company. Great time making hay while the sun shines. But holy crap. If we had just bought all those properties, went to a hard money lender, put a little money together for the renovations and so on and down payment, refinance them out after they're leased up and renovated. Man, oh man, yes, short term, it would have been more work and it would have been more investment of capital. However, in the long run, now looking back 5 years later, I'd have probably 3-4 times as much assets under my belt. The cash flow would be nice. We'd be refinancing those, getting a big tax-free payout every few years, and having 100+ properties basically all throughout Essex County would be a good spot to be. So I learned, don't sell your real estate at the end of the day.
Yeah, I started in Jersey City in the early 2000s, and I was buying I'm pretty sure I mentioned a few times. I was buying 3 families for $75,000. I was buying 6 families for $125,000. Fix them up, rent them out a little bit, and then flip them for $290,000, $300,000. And now I'm like, man, I still got 81 doors in Jersey City, which is still great. But I would have had well over 200 if I didn't sell all those properties. I'm like, man, I'm really kicking myself in the butt.
Yeah, absolutely. When you sell, you got to pay taxes. The broker gets their 6%. You look at the HUD, you're like, okay, the bank got, we owe them. You got transfer tax. The broker made out like a bandit. You pay the home, you pay everyone, and then you finally get what's left over. The sale of real estate is sometimes misleading, because you look at different comps and everything like that. But you really got to work out the numbers of it. I've bought and sold a 25 unit in South Jersey, and we did very well. It kind of got me into the syndication space. I bought it in 2014, sold it in 2016. And the main reason we sold is we want to consolidate up here in North Jersey and be within about an hour of all of our assets. It was a good choice. But looking back, holy mackerel, it's probably worth a multiple of what I sold it for. But on top of that, we ran the numbers. It kind of made sense, but it was also, man, the broker, he made 6% sell it to us. He made another 6% selling it for us, right? We moved to the broker, and that guy's great. He brought us another deal, actually, a great deal in Rahway. That's like one of our best investments ever. So in the long run, we kind of fed. You don't bite the hand that feeds you. He gets us good deals. We give him back the listing, if we're going to sell the property, which is a little trick of the trade there.
I thought about that, and it was actually a thing I spoke about a few weeks ago. And if you think about it, you sell a property, you're going to make you're going to sell it 100%, right? So you're going to pay all these fees. You're going to make X amount of dollars. So you make $400,000, whatever the case may be. But if you cash out refinance at 75%, that 25% is basically all the fees you're paying out anyway at the closing. So you're still netting the same amount of money at the end of the day. So you're just better off keeping it, refinancing it, and keeping the asset. And I've looked at the numbers. I was like, you know what? That was so stupid of me to sell some of those properties, because I look back at it now: commission, closing costs. If you don't 1031, you got to pay gains, all that stuff. So you actually, with the gains and all that, you're going to net far less.
Yeah.
And selling that, when you sell that property, then refinancing. So at the end of the day, it's just like, just keep it, because it doesn't make any sense. You got the equity, cash out, refinance, raise the rents, and you're still ahead of the game. So.
Plus you got to go find another deal, which in the last few years has been few and far between.
I had a 1031 I was doing, and we're actually 1031ing into that Illinois deal, and the sale kept stalling, and then eventually just expired anyway. So I was like, why did I sell those properties for? Now, I actually ended up losing more money than I should just, if I refinanced them and held the money in my account till we closed, so I actually lost money doing the 1031 than saving money.
Wow. That's crazy. Yeah. I mean, when you work in the capital gains tax, right, 25% of your gains gets taxed right there to the IRS. You work out of the broker fees. Like I said, when I bought and sold that 25 unit over a 2-year period, the broker made, 70, 80,000 on the purchase, another like 130,000 on the sale. Our investors did well. We did okay, but really the main reason we sold is just because the location was too difficult to manage and we want to consolidate up here. But if that wasn't the case, I would have definitely held on to it. And the broker definitely made more than us at the end of the day, you know, when you buy and sell property that quickly. Yeah, because we have investors, you know, we have different expenses and things like that. Capital gains tax, right? So what do you really, it's what you keep, not what you make.
Exactly.
And I talk to investors all the time like that, you know, and they explain, oh yeah, well, I'm going to, you know, invest in a deal and they can, you know, 2x my money in 4 years and And then we start to break it down. We say, okay, well, they're going to buy a building and sell a building with you. What type of gains are you going to make? How much of that is taxed? Okay. So you invest 100,000, you made 100,000 in 4 years, but you know, right away, 25,000 of that gain is going to have to go to the IRS. They also have, you know, different disposition fees and incentives and things like that. So we work out the numbers and we're like, okay, so at the end of the day, you're actually not 2xing your money in 4 years. You're actually, you know, really more around this play, you know, and that number is very similar to what we're getting on a refinance. So
yeah, exactly. That's what we're doing with even with our investors. Like, you know, I tell them from day one, I was like, when we group the money, like I was buying, you know, 3 families, 6 families, 12 units all on our own. I was like, let's get to larger assets. And we all group our money together and let's just build a nice portfolio of, you know, a few thousand apartments and we keep it long term. You know, what's the point? If you're buying 12 units, you're buying 12 units, you're buying 12 units. Let's all put our heads together, put our funds together, and let's, you know, build a nice portfolio. At the end of the day, you know, if we own 5, 6, 7,000 apartments in 10, 15 years, you know, that's our retirement right there. You can't rely on Social Security. You can't rely on government. You can't rely on your employer. You can't rely on your 401k, you know. And that's why, I guess that's probably why I want to name this the wealth of, you know, transfer wealth, because now here we are back into the 1980s and you have this inflationary period where the rates are going up, inflation is through the roof. And what happened in the 80s? The rich got richer and the poor got poorer. And now here we are back in, you know, 40 something years later. And now the middle class is getting wiped out, you know, so, and that's exactly what's happening. It's been staged and planned for decades and exactly what's being implemented right now. So unfortunately, it's one way out is investing.
Yeah, absolutely. You know, I think sometimes like, okay, you know, what if I did, you know, sell all my real estate at one point and have a bunch of cash in the bank? What would I even do with it? And like, I think about it, I'm like, well, there's bonds, but they go up and down. And, you know, bonds got nailed in the last year. There's treasury, but, you know, okay, fine. Like you can get a solid 3-4% maybe, you know, there's CDs, there's a stock market that's, you know, over time going to generally get a decent return, but it's very volatile and taxed when you want to eventually pull out of it. And it's just like, man, I really just want to own a lot of apartment buildings and I just trust real estate, brick and mortar, high demand assets in a good area, well managed. I just trust it so much more than putting it in a mutual fund. And I hope that works out, you know, or putting it into a treasure, you know, getting 3 or 4% and kind of being stuck there. You're just never really going to grow enough in smaller, more safer investments. And, you know, so real estate has a little bit of risk, but when it's well managed, not over leveraged, owned in a strong market with strong operators, you dilute so much of that risk. It's very similar to being in a mutual fund or something like that. And that's exactly what we try to accomplish.
You made good points. Like, you know, you got the treasury, you got the bonds, you got the CDs, and, you know, what are they going to be, 3-4% if you're lucky? You know, you're still not outpacing inflation with those numbers. So you're still behind the 8 ball, even though you think you're investing, you know, you're making good returns, but you're still way behind the 8 ball. And, you know, don't get me wrong, you got millions and millions of dollars sitting in there. Yeah, it might work well. It might work out well, but, you know, for the average, you know, person makes $200,000-300,000 a year, whatever the case may be. You know, at the end of the day, it's still not outpacing inflation. Where real estate, you know, statistically, it has outpaced inflation every single time. Obviously, you get the tax benefits, and again, like you mentioned, once you pull the money out, you get taxed. So, and then when we refinances are, you know, I'm doing some cash out refinances right now. We're pulling out, you know, well into the 6 figures, and I don't get taxed on that. I'm taking that money, I'm putting it back to work. I'm going to make more money. So at the end of the day, if you know how to operate real estate, really minimal risk.
Right.
You mentioned, you know, so.
And it's also the buy, renovate, refinance strategy. Using debt to pay yourself is exactly how the most wealthy people own stocks too, right? The whole strategy in the stock market, if you're super wealthy, you basically borrow against your stock portfolio. And that's a really smart way to pay yourself with your stock portfolio without selling your portfolio, because stocks are a good investment too. You do want to have a percentage of your investments in stocks, of course. And so that's exactly how it's done for the most wealthy investors, the most savvy investors in the stock market. You know, they don't dump their portfolio, they borrow against it as it grows. They use growth of the portfolio to cover the interest charged on that debt, and they don't over leverage. The banks don't allow them to, of course. And so there's safeguards in place for that. But the bottom line is that's the same exact strategy. You know, you have an asset, the asset grows in value. You borrow against the value of the asset, and you don't pay taxes on that money that goes in your bank account. You know?
Exactly. That's exactly the way it works. But then your average 401k, you know, who's managing that? Who's operating that? It just goes up, it goes down. You know, you got 200,000, it goes down, you're back to 100,000. And now you can work even a few more years to even catch back up to the 200,000. You know, so it's to me, like I've watched, you know, friends and family. And my brother, my sister-in-laws, and all that, they watch their 401k. It's up and down, up and down. And it's really nerve-wracking, especially the older you get. It's like, okay, I had $500,000 in there. Now I'm down to 350. Well, I got to work another 25 years still. I'm going to get back to 600,000. Is it worth it? You know, so take it out and reinvest it. And actually, my wife, she had 401ks and she left the workforce. And we pulled that out, did a self-directed 401k. And we tripled that money hell a lot faster than you know, someone else operating that 401k.
Yeah, no, absolutely. Yeah. IRAs, 401ks are a great way to invest in real estate. For those who don't know, you can self-direct your IRA or your 401k into real estate. You need to team up with an IRA custodian to do that. We work with a number of them. A few good ones are, you know, Madison Trust, Next Generation Trust. So there's a lot of good IRA custodians out there, but you pick the right one for you and you move your IRA into that IRA custodian, and then you can self-direct it into an asset that is not managed by you. You know, you can't take a fee or things like that. It's not a way to pull early on your IRA, but it is a way to grow your retirement nest egg faster and more aggressively, and diversify some of it out of the stock market. So you're out of the casino, the stock market, into more tried and true assets like real estate. But of course, you want to diversify your IRA no matter what. So it's a good way to just diversify that. And I've seen investors get much better gains in their IRA by doing that. So yeah, about a third of our investors self-direct their IRA into real estate. It makes sense. It's a long-term investment. You know, you don't need the money right away. You're looking at 10, 15 years, 20 years down the road. So that's a great way to do it. But let's talk about the 1031 tax deference for a second here, right? Talking about legacy wealth. We're talking about the great transfer of wealth and being able to transfer wealth down to your heirs, essentially with the best tax strategy as well. Because you see some of these stories where someone passes away and their estate's not set up properly, and maybe they did well, you know, but it just wasn't set up properly, and they're getting nailed on taxes and the death tax, and you're giving, you know, 30-40% to the government, whatever the scenario is. You know, it hurts you to think, oh man, that person worked their whole lives to build this wealth, and now a good piece of it's just going right to the IRS, and their kids are left with whatever's left over. And, you know, I kind of even saw that a little bit in my own family. You know, my grandpa did very well building wealth, but it perhaps wasn't structured properly. So they ended up kind of having to pay taxes on all the wealth delivered. And I don't even know if they realized how much wealth they had, right? You just keep putting it away in the stocks and bonds, and, you know, 40, 50 years go by, like that's worth a lot more, you know? And I was talking to also a state attorney, and he was saying, boy, with about $2 million of net worth, it makes sense to do a hybrid trust. That was a podcast episode about 2-3 episodes ago. So check that one out on the Passive Cash Flow podcast we have. But a hybrid trust, from what I understand, it's basically a combination of kind of having a trust set up in the Cayman Islands, an offshore trust essentially, and then having that ready to go, but running your business in America through you know, US based companies and LLCs, so that you're able to do the things you need to do with your business, but then also having that shell ready to go to kind of move it right offshore if you need to, in the event of, oh crap, I'm going to lose this lawsuit. I'm staring down the barrel of, you know, a $5 million loss, and I'm going to move my assets offshore very quickly because that's already set up That's from what I understand. Listen to the podcast episode for a better explanation. That's a hybrid trust.
Okay. Yeah, I never heard of a hybrid trust, but I've heard of, your regular trust, and we have a living will and a trust set up already. All that stuff has been almost 7-8 years. We've set that up a while ago because we just started building a portfolio. And I'm like, well, I'm not giving this away if God forbid something happens. And as you know, my health wasn't all that great a few years ago, and I had a huge scare, and I'm like, you know what? Forget about it. So we went right to the lawyer, got everything set up to be on the safe side, and took care of my health, so I get at least another 50 years out of myself.
No, congratulations on that, man. You lost a lot of weight. I know you're working on that. I deal with the same challenges, and it's hard to lose weight. It is absolutely
it's crazy. But that's we kind of set everything up. Every property is its own LLC, and S corporation owns all the LLCs, and then from there forward it goes into the trust, and everything's held in the corporations are held in a trust, and have all the living wills set up. So
nice.
That's so far is all set up. Hopefully, I want to look into the hybrid trust and see how that works. That's something of interest for sure. Curious to see how.
Well, at the wealth level you're at, it definitely could make sense to have something like that available. Then what Brian Bradley was saying, the state attorney on the podcast, was that anything over $1.2 million, it starts to make financial sense, because there is a cost. I think it's like $20,000 up front to set it up, and then it's like a couple thousand a year to maintain it or something. So you want to keep that in mind. But that's great to have. And that's a big part of handing generational wealth down properly to your heirs, having the best tax strategy. Because like I said, the saddest thing is when you see someone pass away and their years of accomplishments just be sucked up by the government to go into the abyss of who the hell knows where our tax dollars go. So it's just frustrating. But let's talk about 1031 tax deferences for a second, because the wealthy use that to become more wealthy. 60% of billionaires' wealth is held in real estate. So they must know something. So what is a 1031 tax deference?
Tax 30, it's basically what you're doing is you're selling a property and you have your gains, and you're not pocketing the money, because if you pocket the money, it's going to being taxed. So you're hiring a third-party intermediary to hold the money in escrow while you look for another asset to flip that money into. So basically, you're just using your money to make more money with. If you needed the cash, you can always take a boot percentage of that money to put into your bank account or have cash available, and that portion will be taxed if you need the cash. But like you mentioned, multimillionaires and billionaires, they don't need the cash. They got already cash coming in. You have cash flow coming in. So that's why when we do our 1031s, like, do I really need the $200,000-$300,000 sitting in a bank account? No. I just want to put that money back into work and not be taxed. And we've done that a few times. But as you know, the market, the past, probably 18 months, 2 years, it's hard to find good deals. I think we're at a stagnant. Right now the sellers still like, okay, the reality hasn't set in, the rates are going up. So the reality hasn't set in for the sellers to say, okay, these numbers make sense or don't make sense. And obviously the buyers are just sitting on the sidelines. So you got to be careful, I think, with the 1031s. I know, we kind of got hosed on the last one, which sucks. I know other investors are sitting there, trying to identify properties, but you can't identify anything that makes sense. So like I mentioned, a few minutes earlier, I think you're probably better off cashing out refinancing in this market if you can. That way, you're not getting taxed. But the 1031s work great because you're just buying another property, you're flipping that money into that deal, you're not being taxed on it. You're buying a bigger asset that's going to cash flow more money, and then down the road, say, okay, you know what? I'm going to sell this property. I've transferred $200,000. I'm making $600,000 on this sale. And then you move on to, from 600,000, you move into a $20 million deal or $10 million deal, and your money's just growing. That's basically what you're doing, tax deferred. So.
No, it's really, really an incredible tool. And, but yeah, you're right. One of the challenges of it is, you sell in a hot market, like we've seen for the last few years, you got to buy in a hot market, right? You got to buy in a seller. So now you're just kind of trading, great value growth for then kind of overpaying for your next property, unless you got a great deal, right? But it's hard because you have about 90 days to identify 3 similar sized assets and kind assets, right? And then you have about 90 days to close on them. Is that correct?
6 months to close.
6 months to close. That's right. Okay. Yeah. So it is a bit of a juggling act. You have to have your assets kind of lined up. What we've seen and what we've done, and what other people who much more experienced in the space as well have told me, that you really want to start identifying the properties you're going to buy before you even close on the asset you're selling. Now, the challenge is real estate's not completely liquid. It takes time to sell an asset. It takes time to buy an asset. So but you really need to start looking before you even list your property for sale, and sometimes the best ways to do it also is have your own internal buyers network. But for the most part, you list a property for sale with a broker. That's going to get you the best price. That'll show what the market is bearing if you have a good broker. And that'll allow you to sell for top dollar. And then at the same time, as you're doing that, you want to be lining up your next transaction, doing your due diligence. And hey, it may take a little money you got to spend over here to kind of line up deals and do due diligence before you even sell the property over here, and now, oh shoot, this buyer I had backed out, that delays this, so it is a juggling act, and there's challenges to that. But if done right, let's just do a scenario. So this is how people learn best. Let's say you sold a piece of real estate and you made $1 million in profit. Okay. Now, if you 1031, you take that full $1 million in profit and you're able to move it into a new asset. Let's say you can buy a $3 million asset. Okay. 25% down, renovation costs, closing costs. So $1 million gets you a $3 million asset because you're using a mortgage to buy the real estate, right? You're going to get a $2 million mortgage, right? Okay. So now let's say you sold and you didn't do a 1031 and you just kind of putzed around and bought something a year later. All right. Well, now you had, instead of $1 million, you have $750,000.
Maybe less.
Right. And what does that buy? Well, 3 times 750 in the same purchase scenario, that gives us $2.25 million in real estate.
Yep.
So in that scenario, we bought $750,000 of additional real estate value, right? A $3 million building instead of a $2.25 million building because we did a 1031 tax deference, right?
Exactly.
Yep. All right. So that's now put another 0 on it, right? That can just keep building and building and building. So that's the idea. By doing a 1031, you've achieved another $750,000 of real estate purchasing power. And that's a big freaking number. So, that's a nice way to explain the power of a 1031 and why the rich use it to get richer. It makes a lot of sense.
And I think if you look at the past few years, a lot of people doing 1031s and they're probably overpaying for the deals that they were acquiring and I think that's what drove the market up also, because they didn't want to get hit with the taxes. You're selling a $10 million asset, you're making $5-6 million, whatever the case may be. 20, 30%, 30% of that is a huge chunk. They wouldn't mind paying, hey, listen, if I don't have to pay $600,000, $700,000 in taxes, I'd rather overpay for this asset. I know it's going to cash flow in either way. I think that was probably a big driving factor in why we are in this market we are now. It's inflationary numbers.
So, and now
what the Fed to come in and the Fed says, okay, now we're going to raise rates. Now you're stuck here. So now what these sellers are going to do? You can't cash out, refinance, because now your value, diminished because now your rates is much higher than you anticipated them to be, a few years ago. So
exactly. But now you can also 1031 into a syndicate. So we actually are going to be working on possibly setting up an entity that can take a 1031 capital. There's a couple different ways to do it. There's a Delaware statutory trust. There's tenants in common. Both have their pros and cons. But we're working on structuring something like that for our investors, because I get calls all the time. Hey, I got an asset, my partner on it, we're not getting along. I want to sell it like ASAP or whatever. It's 6 hours away and I'm tired of driving up to Syracuse to manage it, So, people, there's so many stories in real estate. Usually it's too far away, or I'm getting to an age where this is tiresome, or my partner's annoying me. I just want out. I bought it with my siblings and now we're not getting along. I just want my brother. So there's a lot of different scenarios like that. And I talk to investors all the time and they say, hey, but I want a 1031 into one of your deals, right? I like what you guys do. I know you have a good infrastructure in place, a good track record, but I don't want to sell it, pay a bunch of tax, and then invest the money in People's Capital Group. I just want a 1031 into People's Capital Group. And I have to say, sorry, we don't have that structure in place yet. So we are going to be structuring that, but there are other syndicates out there that accept 1031 capital as well. And that could be a great option for someone looking at 1031 and kind of put their feet up and get passive income also.
I think the tenants in common is probably the most used practice from what I've seen in the past. And Delaware it's a statutory trust. I've never dealt with that, so I've just heard about it, but I'm just not too familiar with it. So, but no, tenants in common has been one that we used in the past.
Yeah, absolutely. Yeah, it just gets complicated with who's, you want to have certain people managerial control and other people to be more passive. And then you have the debt complication that comes in place, TIC more, everyone has to sign the debt, where a DST, you could structure it a little bit more so the investor doesn't have to sign the debt, but then you have complications on the management and operations side of it kind of. So, it's definitely more complicated than a regular syndication, and but it's something that it's a product I want to offer to our investors. One thing I've noticed, the space we're in, the syndication space, the more products I can offer my investors that are different, the more I can help people invest in real estate. And it's really incredible. We sent an email out on Tuesday of last week that we are starting to do short-term promissory notes again. And we haven't done this in 5 or 6 years. We've just recognized that, hey, there's a lot of residential deals starting to pop up out of the woodwork. We also want to start going to sheriff sale auctions again and start snagging some sheriff sale deals there. We've done some of our best work there through the years. And we're also just seeing opportunities where we ought to move quick, and so on. So we need a cash ready to go for those opportunities. So we go to our investor base and say, hey, we'll do short-term promissory notes, 6-month investment term, 8% annualized interest, and we have 5 spots open. Since that email, 4 of the 5 spots have been filled. It's just been incredible. We really don't need to fill the 5th spot, but we'll probably want to bring on a new investor for that. I always like meeting new investors. So, but just that's a good fit. I talk to our investors. I say, what are you looking for right now? And everyone says, I want a short-term investment. Are you finding that?
We have some investors that we've dealt with. It's the first time we're doing a syndication. A lot of the properties we own outright, just myself and my 2 partners, for the most part. So we kind of, even with the state Illinois deal, we closed. I put in $1 million of my own funds into the deal, easily closed it without any syndicates. I just want to get my feet wet in the whole process. So we put in some investors, but we short-term stuff. I'm really not tackling or going after the short-term investors. I'm pretty much going after the larger investors, $500,000, $200,000 minimum if I can, that I'm speaking to, for the most part. But I haven't tried that with the short-term stuff, to tell you the truth, because I'd rather just have them becoming partners. My goal is to build a group of investors where we can lean on each other, say, okay, listen, I'm putting in $500,000, you guys are putting in $500,000, let's go buy $20 million asset. Let's go buy $10 million asset. Because with the agency debt and all that stuff, it's not 25% down, it's 20% down. If it's a class A, you might even get down to 15% down payment. It makes more sense to do something like that and just build that team. That's my goal, is to build a team of investors, and let's hold this in perpetuity for the rest of our lives, for our kids, and just pass it down. That's the goal, because at the end of the day, like we mentioned before, if you sell it, what are we doing? We're making the government rich.
Exactly.
To me, it doesn't make any sense.
No, absolutely. And that's probably something we'll be doing as well. We'll probably be looking into starting a 506C later this year as well. That'll be for accredited investors only. Generally minimum investment $100,000 for that, and then the next levels will be $250 and $500. So that's going to be for some of our larger accredited investors, which we really appreciate throughout our network. But we also have a lot of sophisticated investors, school teachers, firefighters, police officers, sheriffs. So the whole spectrum there, home builders, the whole thing, and it's really interesting, helping all different types of people invest in real estate. And I really love working with the full spectrum, and explaining to people what real estate syndication is, how to build wealth in real estate, whether they're investing $30,000 from sort of self-directed IRA, as a school teacher or something like that, or a multimillionaire putting 6-7 figures with us. We appreciate it all, and all the same. And I work to service all those different investors all the same as well. So, but we'll probably in the future start having different funds, one for our larger accredited investors and one for our smaller sophisticated investors. But I always want to have a place for those smaller sophisticated investors. It is a little more difficult to service them sometimes, and they aren't making smaller investors. So you're talking to a lot more people, but there's just a great pride that comes to helping people diversify in real estate that normally couldn't, because they are not accredited.
Exactly. And I think a lot of them want to invest in real estate, don't know how to invest in real estate, and if you start off and you're really not educated on real estate, there's a good chance you're going to lose your shirt You're going to speak to a lot of newbies. And what happens? They jump in the market. Why they jump in the market? Because everyone's doing it. And that's usually the peak of the market. And then these guys jump in and you get hosed. So it's always good to have the smaller investors come in, guide them through, or invest alongside us or you. That way, everyone benefits from it. So,
oh yeah.
Makes sense.
All right, my friend. Well, we got a lot of questions here. So why don't we open up and start answering some questions here, and we'll see if we can help answer these properly. So Kat walked on a keyboard. Okay, we got that. That's nice. So Mel, how do you look to buy look for mobile home parks, state size, cap, etc.?
The mobile home park is a bit different than the real estate business. Yeah. You're actually a city. That's the way I kind of look at it. Because you own city streets, you own city sewer lines, you own city water lines. So there's a lot more due diligence that goes into mobile home park due diligence and analysis. And then again, it boils down to the demographics in the areas. I don't think it makes much of a difference how you analyze an apartment building than a mobile home park. You still want to be in a large MSA. You want to make sure you have good job growth, you have good population growth. With the mobile home parks is, my forte is affordable housing. That's what I like to do. So it's another, I guess, staple in my portfolio of affordable housing. So we'll get into, we look for major cities again, median household incomes, median home prices and stuff like that. And then really at the end of the day, you're in Bergen County, New Jersey, they have mobile home parks. There's always demand for it. Right. So the way I just kind of look at it is like, my affordability, the way I invest in affordable housing is like when the recession hits, right? People have to foreclose on their homes, short sell their homes, and they move into Class A apartments or Class B apartments. And the Class B guys say, hey, Leon, I lost my job. I can't afford, $1,800 a month in rent. I'm moving down to $1,000 a month in rent. Then your Class C guys are moving down to, and down the chain as the markets get worse. Right. And then you end up in my mobile home park. And that's like, that's your step before homelessness, So I'm at the bottom, collecting all these applicants while everyone else is just trickling down to me. You know what I mean? So the box, it's got to be double-digit returns. But again, you got to keep in mind when you analyze these deals, you can't analyze a 6% cap. You can't analyze a 7% cap because you're going to have a lot more expenses that you need to underwrite for. Like, for example, in our park, sewer lines break. Guess who owns the sewer lines? We do. Right. So we got to dig up the sewer lines. Water lines break. They freeze. Who's digging those up? We are. We're the city. We're the DPW. I'm the mayor. We're the DPW. We're everybody. We're the lighting company. We're, the utility company.
Right.
So when you underwrite these deals and it's like, oh, it's a 5% cap, 6% cap. Let me tell you, that's a negative 20% cap. Because after you underwrite all those expenses and maintenance and reserves and stuff like that, there's no way in the world those deals make any sense whatsoever. So you really got to know what you're doing when you get into that space. And like we bought one from two investors in the Indiana market. They were single family home guys, apartment guys, and they bought this park. It's like, oh, it's going to be a great deal, and it's a great deal on paper. Don't get me wrong, if you know how to operate it. But honestly, they had no clue what they're doing, and we took it over. And we just bought, we couldn't even get financing on the park because it was over 50% vacant. It looked like a junkyard when we got it. So I was like, all right, let me call. I was like, who's your loan with? So they gave us the bank. I reached out to the bank. I spoke to the bank president and we negotiated terms with them to assume the mortgage. Right. And we got better terms than they did. I built my portfolio. I was like, this is what I do. I'm in construction. I understand all this stuff.
Yeah.
So we took over the park for $25,000, and now we're almost at 60% capacity. So now that the market's starting to recede a little bit, and what's happening in the market, I was like, let's wait a little bit, bring in the cash flow, because every dollar for the past 2.5 years we're putting back into the park. New homes coming in, new pads you got to set up. Right. New water lines, new electrical meters. Like this is, it's no joke.
Right.
It might look like it's simple and easy, but it's not. So we're putting all that money back into the park. Now we're at a point where we're cash flowing, over 5 figures a month on this deal. So I was like, you know what? Sit back. Let's cash flow a little bit. See what happens with this recession. And then maybe in 18 months, 2 years from now, we'll reassess and, expand the park, because we still have some more pads available, outfit. So we have the demand, so it works out pretty well.
Yeah. Wow. I really haven't even delved into the mobile home park space, but you're right. You're owning that whole area and all that land, all those pipes and wires and meters. And that's a lot to maintain. It's a lot of overhead there. Yeah. And are you having trouble with collections, working with, different demographics with the mobile home parks?
Collections, I would say it's anything similar to apartment complexes.
Yeah.
The only thing with the collections is that, what we do is you have 3 options, right? You can rent the land, and you just a landlord, you're renting the land to somebody who has their own home.
Yeah.
Option number 2 is you're a landlord and you rent it out as a landlord. And then option number 3 is seller financing. So what we do is we push for seller financing. So it's like, okay, it's, $1,500 down, $2,500 down, and then you're going to own the home in 7 to 8 years, which is almost the same. The rent and the seller financing is almost exactly the same per month. So to them, it's like we're pitching. It's like you're going to own this place in 7 to 8 years instead of paying $695 or $650 for the rest of your life. Right. So year 7, you're only paying $250 a month thereafter. So we get people that come in, to buy it, seller financing and stuff like that. So we actually make money sometimes that, because what happens is a year later, 2 years later, they just leave.
Right.
And now we got the deposit where we take the home back, because they're not moving the home out of the park.
Yeah.
Because they own it technically. They have to pay it off if they wanted to.
Right.
And for them to move, it's $2,000-$3,000. So that's not going to happen. So you have some turnover here and there, but most of it's like we took a deposit from you. And it's your loss, not ours, So.
And even if they do pay it off over the 7 or 8 years, which probably is not that common, then you're looking at still being able to charge for the sewer and electric and all that infrastructure you have in place.
Yeah. So we build back the water, we build back the sewer, the trash, all that stuff. So it's all built back to the tenants.
Okay.
For the most part. So we're still way below market for lot rent in that area that we're in.
Right.
So we build all that back, which increases our NOI. But then again, 7, 8 years later, let's just say they do get up and leave.
Yeah.
Or whatever the case may be. They don't want to take their home with them. They don't want to, they don't want to spend $2,000-$3,000 to move the thing.
Right.
And they just give it back, they deed it back to us. And now we're back to square one. So we're just recycling it. Yeah.
Got to be worth something though, right? I mean.
Oh yeah, it's worth something. Basically there was a park nearby, probably like 30 minutes away, and they were closing their park down. Wow. And they're like, listen, we got some homes here. You want to take them? Come pick them up.
Wow.
So we got 5 homes for free. And we brought them into our park. We renovated them. Right. And, we sold them for $15,000, $16,000 each. Wow. Okay. $1,500 down. The next 7 months, you would pay me $600 a month. Yeah. And then thereafter, so.
Okay. So they're really, you got to renovate them, and they're not really values more and leasing them up and everything like that. Okay. Interesting. Yeah. All right. Here's the next question. So what are your thoughts on the real estate cycles, 1988, 2000, 2008 timeframes, give or take? From a rental point of view, it doesn't matter as long as the rent is coming in, but from an appreciation point of view, prices do come down and nothing continues to go up in those recessions. What are your thoughts on that?
Well, if you look back, it all depends what market you're in, right? So if I'm in Buffalo, New York, and I bought a house in 1988, it's probably still the same price today, right?
God.
So it really depends on what markets you're in. But if you look historically, it's a single family home in 1988 isn't the same price it is today. Yeah, it goes up and then it comes back down. It might go up 100%, comes down 50, back up 100%, back down 50. So you're always scaling up in the equity, and you're scaling up in the value of the asset over those years. And 88, 90s, 2008, all that stuff. It's all reciprocal. It all happens, right? It comes around. There's always something that creates recession, right? So creating a loan crisis. Then you have the 2001, the tech bubble. 2008, you had the mortgage crisis, and here we are now with COVID and inflationary period. that we're going through and the Fed raising the rate. So they're creating this, bubble that's going to burst. I don't think there's going to be a recession per se like there was in 07, 08. The recession is here, and that recession is inflation. You got squeezed in 07, 08. Now you're getting squeezed with inflation, and you're getting squeezed with interest rates. You're getting squeezed with all that stuff. So that's your recession right now. They're squeezing the shit out of you. And that's basically what's happening, so.
Yeah. What's interesting though, let's say you bought at the top of the market in 1988, right? And you're in New Jersey, right? And you're sitting there, you're like, I'm such an idiot. I bought at the top of the market, or even 2008. Let's take the most recent terrible recession, right? The Great Recession. Let's say you bought at the top of that 2008, September 2008. You're the idiot, right? Who bought last, first week of September 2008 and just boom, right? You'd still be in a great spot if you just held on to it to today. In fact, you'd be in a really good spot if you bought in like Newark, New Jersey, or somewhere like that, or Jersey City, or really any of these North Jersey markets. So that goes to show, location definitely matters. And, that's one of the reasons I do like to stay to this North Jersey area, because we just see such continued demand and a huge amount of population density. I do understand there's a net migration out of New Jersey recently, but at the same time, man, it's so hard to build housing here. There's so much jobs and opportunity and education, and it is a nice place to live. It is, a nice, safe environment. We got, the beach, we got mountains, it is the Garden State. We have some gardens. Two gardens. We have 2 gardens. We got a Newark Airport right there. Lots of infrastructure, but I feel like long term in the right markets, don't wait to buy real estate and wait, because you'd still be in a good spot if you bought at the height of 2008.
Well, I think you kind of said it's like, the idiots that bought at the top of they feel they're idiots because they bought at the top of the market. And if you look back now, like you said, also they're still be ahead of the curve today. So it goes to show there's no idiots that buy in real estate, right? you can't be an idiot buying in real estate. The only idiots are the ones that sold it and lost.
Sold in 2011 and lost their shirt.
They're the ones that lost the shirt. and listen, we go back, and I'm telling you right now, I've done short sales, and these people could easily have afforded the mortgage payments or whatever the case may be. But you know what? They're driving around in all these cars, spending money on bullshit, all this nonsense. If they would have held on to it, they probably could have sold it today for $200,000-$300,000 more than they had it bought in 2008. But they put themselves in debt, and then they had the short sale. At the end of the day, it boils down to financial literacy. And unfortunately,
I remember that time. I would talk to people and they'd be like, I have the money to pay, I just don't want to pay. I don't want to throw good money at bad, and I get that. There were some scenarios where they were really far underwater, but, technically if you just kept paying the mortgage, you would have been above water over time. But, it's definitely a tough scenario. I get it. The banks were forgiving a ton of debt too. So like, if you were $200,000 underwater and you knew you could hire a short sale negotiating company and get that erased and like buy another home 18 months later, that was actually a great financial decision. So, it was just kind of playing the market as well at the time and the options you had.
Exactly.
Okay, let's move on here. Although that was actually technically illegal to do short sales that way. You weren't supposed to do that. Okay, here's another question. What are your thoughts on platforms like Diversyfund?
What? Diversyfund?
I haven't heard of Diversyfund myself. I'll have to check that out. I think, CrowdStreet, Fundrise. Right. What do you think of sites like that?
I've seen those billboards, and those guys are gone already. So when you have these open funds and it's not collateralized, I'm very skeptical of what these guys are doing with my money. That's just like handing your money to the government and hopefully they're doing something right with it. So to me, if there's no collateral, there's no loan, there's no investment. To me, that's the way I operate. And again, like I said, you've seen those billboards on the turnpike, you've seen them on Route 80, and $650 million is gone, right?
NRIA, right? That's the one you're NRIA. Yeah, dude, that's a crazy story. I heard those commercials on the radio all the time. Guaranteed 20% returns. I'd be like, how can they say that? How are they?
No such thing as guaranteed.
Yeah, you're not allowed to say guaranteed. First of all, it's a 4-letter word in our business. Secondly, 20% returns, bro, you're over promising. If you're getting 20% annualized returns, maybe like in high risk, real estate stuff, maybe fix and flips, like some ground up, but commercial real estate, that's a cash and cash 20%. That's not happening annualized.
No way. Hey, look, I love my double digits on cash, but even like in the hood, I'm at 12 to 16. You know what I mean? You just got to tell me that Class A and that kind of number. Good luck.
Yeah, I think the best I've done for my investors is 24% annualized cash and cash return. But I'm not going to go on the radio and be like 24. No, we hit a home run. We're usually good 12. 14. That's a solid cash on cash annualized. Cash and cash. So, they overpromised, they underdelivered, and then some of the people in the company I think just stole money. I saw some, just took the money. Yeah. So.
And that wasn't the first time they've done it. So
So
unfortunately, it just keeps opening up again.
Hey, but it goes to show you, they had so much marketing dollars. They had the best billboards. They had the most radio ads. They were on TV. It was a company that, we look at, we're like, how do we get to that level? Yeah. And it was then when they collapsed, it was really like, wow, that's disappointing. They weren't what we all thought they were. So
so they had opportunities to do it the right way, and unfortunately, greed gets in the way. So like I would say, if there's no collateral, there's no investment. That's the way. Even those the websites, like I think they mentioned, you can invest $1,000 in real estate, $2,000 in real estate. Just anticipate not seeing that money ever again if that's what you plan on doing.
I mean, I don't know. I click around on Fundrise sometimes. I do find there's some value on their website, like articles and stuff like that. But for the most part, they're just kind of like a way to dip your toe into the water with real estate syndication. But it's a middleman. I'm sure some of the things they have in there are good. I don't exactly know how it all works. I think Fundrise actually has their own fund now. So I don't know if they're competing with the people on their site or. But then you have like Realty Mogul and stuff like that, where you can actually like look at projects that are going on and invest in those projects. And some of them may be good, some of them may not be good, right? So you got to make your decision there. But what I'd say is for sites like that, it's really a middleman to get to companies like mine and companies like yours that help people invest in real estate. It's essentially for companies that don't have the resources we have to raise capital internally, which we're very proud we're capable of doing. You go to websites like that and then they fill your fund up. Oh, by the way, they get a big piece of the action, a VIG, and and then you got to pay a fee up front. And so guess what? All those fees those websites charge, you think the operator's just going to take that in the chin? No, it works into the fund. The investors pay it. It's all worked in the numbers. It's called a closing cost, So the more costs your operator's taking on to raise that capital and then passing those costs on to their investors, the less the investors tend to earn in returns and things like that. So I would just say, be aware that those websites are middlemen. There are extra costs involved. I'm not as negative about them as Carmelo. I think there might be good opportunities there. I know you can invest $500 in Fundrise or something like that. I have no idea the strength of those opportunities, but okay. So
it boils down to, again, like going back to newbie real estate investors. If you're going into, with no savviness, have no clue about the real estate investing, and you're just investing into a platform that you have no clue about.
Also, the platform itself, right? Like I've for one invested in cryptocurrencies for Voyager. Voyager filed bankruptcy. I didn't fully understand that if Voyager filed bankruptcy, I wouldn't be able to get my money back. I didn't really understand that. I thought I was buying Bitcoin, No, you're allowing Voyager to own like Bitcoin for you. Like it's kind of confusing. So I don't know how these Fundrise or whatever you're investing in, but just make sure it's not based on the company staying in business, because there are companies like Fundrise and Realty Mogul that are going out of business. And, you want to make sure you're invested in a piece of real estate. Okay. Here's another one. How are you guys finding / marketing for deals in this market? Ooh, now they want all our secrets, Carmelo.
To me, it's more, over the years, I built relationships and they know what I do, and they just get the call, I get the phone calls, I get the text messages. Hey, I got a deal. And that's really it. Like even like the one I got in Hackensack was through a wholesaler that I've dealt with in the past. Bought a 12 unit in Bergen County for 1.2 million. That's $100,000 a door in Bergen County.
Wow.
That's a home run. So, you always find the deals, and I don't mind sitting back 6 months to a year and do nothing until I get the home run deal, And then again, even with the one in Illinois that we got, that was through a broker that I spoke to a few times. And I was just sending every 45 days. I got a group text on my phone. Hey, it's Mel. Just out of sight, out of mind. Keep me in mind. You got any deals? Let me know. And that's how I got that deal. 88 units, and I bought at $27,000 a door. Average the market rent right now in that area is about $750 to $850.
Okay.
That's a home run deal in itself. And then the ones in Wildwood, same thing. Actually, the ones in Wildwood was through a new broker that I met, and we became friends. And I closed on the first deal. Now, when the next deal comes along, he calls me. He knows I close.
Yeah.
That's what it boils down to. At the end of the day, it's just building that rapport. And if you can close a deal, they'll call you back.
Yeah, absolutely. Yeah. We do direct mail marketing. We haven't done it in a while, but we started doing it again with the yellow letter campaigns. So that worked for many years. We stopped doing it around 2020, but we just started doing it again. It's starting to get some results. But that's a slow grind. We have a lot of different landlord relationships. We'll try to stay in touch with those landlords. Some of the best deals I got through the years were from direct mail marketing or even those We Buy Houses signs, but those tend to work better. Both those avenues work better in a bit of a buyer's market, which we are likely to start seeing soon. So maybe it's a good time to start marketing again. But the best deals we've gotten in the last 3 years are from brokers, right? We treat our brokers just as well as we treat anyone we do business with. We want to take them out to lunch every now and then, or just be in front of them through a text or email or phone call. They know exactly what we want. They don't bring us, a warehouse in Georgia. They know, here's what we want: apartment buildings in North Jersey with value add opportunity between 3 to 6 million. Bring us that, so a good broker will bring you that, not waste your time with all the other crap. And the last deal, the deal we're buying on in Bayonne right now, the one we're closing on next week, the $4 million opportunity here. Broker called us up. He said, I know you guys close. I know you're good. I finally got a deal right up your alley. It's a 21 unit apartment building, great location, family owned for 40 years. They just forgot to raise the rent for the last 5 years. It's a good physical condition. Could use a little lipstick, but good overall shape. So really right up our alley. Great deal, good price. But listen, he said, here's the number, right? Here's the number the seller needs. We hemmed and we hawed. We tried to get it for less, but we did end up, working with him and give him the number he requested, and we got it for a good price. A ton of value add as well. So you got to be easy to work with the brokers. We don't nickel and dime them to the closing table. We try not to retrade, although there is a little bit of retrading in this business here and there. You got to do that. Yep. But be easy to do business with, close the deal quickly, do what you say you're going to do, communicate well, and brokers will keep bringing you those deals. Landlords will keep doing business with you. But yeah, I mean, it's really difficult to build those relationships. It takes time. And that's why when people are like, why don't you go to Florida and invest there, or Texas, like every other syndication, I say, we have the infrastructure here. We have the relationships here. It's taken me over a decade to build what I have. I'm not going to go start over again in another state, especially not at this point, so 100 million in New Jersey, then I'll look at other states. That's the goal, my friend. All right. So that's our questions. Oh, I think we got one more here. I know we got to get wrapped up. You got things to do, me as well. One more here. Mel, are the deals you're doing like Wildwood, Illinois, mostly low-income housing, Section 8, Class D, major renovations needed, violations to deal with? Tell us about the deals. All right. Well, we only got a couple minutes here, but why don't you just touch on some of the deals you're doing?
Most of the deals are affordable housing, low income. My portfolio in New Jersey is primarily Section 8. The one in Illinois, we're trying to convert it over to Section 8 if we can, but we're getting a lot of cash paying tenants out there, surprisingly. We're literally 7 minutes to St. Louis, Missouri, which is, obviously a great market to be in. Rents in that market are, 2 bedrooms are $1,800. 7 minutes away, we're at, $750, $800. So I think, in this recessionary period that we're probably going to go through, or downturn, you're going to start people, being smart about their money and probably want to save money on rent. But yeah, Wildwood is really Airbnbs. So there's nothing has to do with low income housing there. It's more hospitality. But I think, every 20 years I've been in real estate, it's hospitality. It's, I got to take care of my tenants and take care of me. That's the way I've been operating my business. And I don't think it's any different from Airbnb and a hotel business and rental business, to tell you the truth. But yeah, most of it I do like low income housing, because I mentioned, once the market turns, that's the class that really fills up. So yeah, absolutely. Yeah, me as well. I like apartment buildings, generally C to B apartment buildings.
in North Jersey. So that's what we're focused on there. But all right, my friends. So let's wrap up here for the afternoon here. I think we had a great turnout. A lot of people joined us here. A lot of great questions as well. And what Carmelo and I spoke about here was how legacy wealth, kind of handing down your legacy wealth. We touched on hybrid estates and kind of estate planning, and also the 1031 tax deference, and using that tool to defer all taxes and swap till you drop and build your wealth, hand it down to your heirs over time. And there's just a lot of good real estate tips of the trade here. Both of us have done hundreds of transactions here, millions of dollars of wealth created for ourselves and our investors. So I don't know if you had joined us through Carmelo's network or through our network, but I'm glad you joined us here, and hopefully you learned a lot of information. We do an in-person networking event, which is a great way to rub shoulders with like-minded investors and meet other people in the industry and out of the industry as well. So whether you are a real estate investor, a wannabe real estate investor, an active investor, a passive investor, maybe you're a doctor or a lawyer, a school teacher, maybe you don't work in real estate at all, but you want to learn more about it, or you're in real estate, you're a realtor, you're a home inspector, you're an attorney, come to our event. It's a great place to learn more about the industry and meet people doing things. And it's at a brewery, so you can enjoy some drinks and dinner as well. So that's going to be February 21st at the Jersey Cyclone Brewery in Somerset, New Jersey. So we actually have over 100 RSVPs. It's usually standing room only. It's a packed house. So that's a great way to learn more about what we do and how we help people invest in real estate, and also build your network as well. I'll be speaking for about 20 minutes about the art of the deal. I also put our website up there, peoplescapitalgroup.com. Great place to catch more of our podcast episodes. I think this will be episode 131. So we have over 100 episodes there. I do a webinar almost every single week that goes on the website as well. So check that out. Tons of content, ebook. And Carmelo, how could people connect with you?
You can reach me at allycapitalmanagement.com if you're looking to invest in some of our deals that we have going on, or just Facebook, Instagram. You can always reach out to me. Yeah.
All right. Awesome. And remember, that's Ally Capital, the Y, not Allied Capital, which I always put in. I'm always like,
Ally, yeah. A-L-L-Y, yeah.
This company's huge. What's Carmelo doing? Allied Capital is like an international fund. Yeah. Okay, cool, man. Cool. Awesome. So allycapital.com. Excellent. Yeah. It's really interesting what we do. We're kind of a similar business model in a lot of ways, but also Carmelo's a little more national. You have different opportunities in other states. I'm strictly apartment buildings here in New Jersey. So there's not a right or wrong way to build wealth in real estate. The bottom line is you got to be doing it. You got to be investing. You got to be learning about what you're doing, making smart investments with smart operators with proven track records. Really doesn't matter if it's Illinois, New Jersey, New York. Start investing in real estate wisely with good operators that you trust and like. All right, my friends. So that's it for today. Absolutely. Thank you so much, Carmelo.
Thank you, bro. I'll talk to you guys, man. Have a good one.
Thanks a lot. Have a good one. Thank you.